Hi, this is Azad Ahmed. Again, we're going to continue our discussion about investment products. This is chapter 8. Now we're starting for the Canadian Securities course. And in this chapter, we talk about equity securities, common and preferred shares. So these are two main types of investment products. You already studied about bonds in the previous chapter, number 6 and 7, which are fixed income products and other products where you get a fixed return, where you get interest payments and there is guarantee of your principal also. So now we're talking about the shares and equity securities. So let's take a look at these in more context. The purchase of common or preferred shares, it means you get an ownership. Ownership meaning you're buying a percentage of the company. In other words, you are able to actually get an ownership. And when you buy a couple of shares, you're only buying a very small percentage. Unless you're getting like 10%, 20%, then you have more say, more control of the company. And if you get more than 49 or 51% of the company, then you have a majority stakeholder stake in that company. So the the usually shares, they will increase in price usually if the company does well. In other words, if the company makes a profit or the company reputation goes up, then the return on the investment will increase. In other words, the share price would increase. However, there's no guarantee. So with the investment in a share, it depends on many factors, internal, external factors. As we discussed with a corporate bond, there is again a risk there also. There's risk because interest rates may go up or down, right? And based on that, the investors may see a big impact even on the value of the corporate bond. As you remember, in corporate bonds, the values may go up and down due to various reasons, due to interest rates or other reasons. So based on that, we are going to discuss about this in more detail. Why companies, they would issue shares or they issue bonds. In the case of the bonds or fixed income, the company actually does that because they want to get a loan from the investors. So now the company becomes a creditor. So as a creditor, um, so the bondholders actually, they become a creditor because the bondholders, they are entitled to the money from the company at the end of the maturity, right? And so if a company goes bankrupt, first of all, the company must pay the bondholders, the fixed income product owners. Then after that, the common or the preferred shares would be paid out. So it's more risky, of course, as you can obviously see. The shares are much more risky than the fixed income or the bonds. Okay, so we'll continue our discussion in the next slides also.